recognize the presence of the CEO of the Nairobi Securities Exchange. You are most welcome. Distinguished ladies and gentlemen, all protocol observed, karibuni sana. We'll have a very snappy and to-the-point program, and we shall be keeping pace to ensure that we are just in time. We shall be starting off with key remarks from Mr. Arthur Oginga. Thereafter, we shall have a socio-economic overview from Wangari Mwikia, who's an economist, after which we shall have an insights presentation. We shall have Vuyokazi and Nanzala speaking to that. And thereafter, we shall have a panel discussion, as you can tell from this setup here, which should take us about 40 or so minutes. And after which we shall have closing remarks, and we shall be free to network after that on the engagements which we'll have taken out from this and how this is going to impact our lives. So to set the scene, it's my distinguished honor to invite Mr. Arthur Oginga to kick us off with the opening remarks. Let's give him a round of applause as he makes his way to the stage.
Good morning, everyone. It is my privilege to once again welcome you to this inaugural launch of the Old Mutual Financial Services Monitor. But before I proceed, I would just like to acknowledge the presence of my colleagues in EXCO. If you could just stand up so that those present can see you, including my other colleague from the Johannesburg EXCO, if she could stand up as well. Thank you. So that's our leadership team, in case you would like to speak to any of them. We are starting the year with a very important piece of research into financial behaviors of Kenyans. I don't think you'll find anything in this research surprising. After all, most of the people in this room are Kenyans or behave like Kenyans. But the important thing with this research and what it brings to the fore is, so what next? I think that's the key question. And we'll try to talk about that through the presentations. Old Mutual has been operating for over 179 years in the continent. We are currently present in 13 countries. We have in excess of 30,000 staff across these 13 markets, including 500 qualified professional investment advisors, and serve approximately 14 million customers. We manage in excess of $12 billion US, or approximately 2 trillion Kenya shillings of customer funds across the continent. In East Africa, we offer short-term insurance, life assurance, asset management, and we also offer banking through our business in Faulu. As you're aware, we rebranded to Old Mutual. Our one brand shift is geared towards leveraging our technical capabilities, skills across the continent, and the research presentation is an example of that. We also leverage our balance sheets within East Africa region and within the wider African continent. And the culture that we have shared across the group really helps us to do great things every day for our customers, employees, and communities. Our victory condition is to be our customers' most trusted partner to sustain grow, and protect their financial prosperity. That may mean many things, and it does mean many things. But the two most important things from my perspective is that we offer very personalized, advice-led solutions. And we also adapt to customers' needs as they evolve and change over time. And that's very relevant to the study as well. In recent years, we have adopted what we call an integrated financial services strategy, which simply stated means that we can offer most, if not all, financial services under one roof. It's really our way of simplifying and streamlining financial journeys for customers. Today, if you walk into our Kimathi Street branch, you walk into our Mombasa branch, you walk into Kisumu, you will be able to find people who will offer you most, if not all, financial services under one roof. Deal all of your queries under one roof. Turning to the Financial Services Monitor, while times may change, the things that matter most don't. So, your family, security, physical and mental health, as well as financial well-being, don't really change. As Old Mutual, our victory condition is about enabling households achieve these things. Our medical business supports mental and physical health, whilst our short-term business, our investment business, our banking businesses ensure your financial wellness. The insights from the research are telling us that Kenyans need help with financial wellness. Basic financial concepts, setting of financial goals, instilling saving habits, etc. The sustainability of our business is directly linked to levels of financial awareness and education, and helping build financially healthy and resilient households is our objective. We are over 100 years old in Kenya, and we expect to be here for over another 100 years. So we've taken a long-term view on what we are going to do around enabling access to financial education. We have an online platform called On the Money. If you have time, please look it up. On the Money supports customers to form good habits and or to change bad habits. It's available. Your children can use it. It's very easy to use and very user-friendly. We have a partnership with KICD, which we're very proud of. We have partnered with KICD at school level. And what we are doing there is embedding financial literacy training in the school curricula. We have completed a pilot, which was quite encouraging. We have seen young children talking some basic financial concepts around savings, and that has transmitted into communities. At university or tertiary level, we have trained over 13,000 university students on financial literacy. This is our second year, and we continue. As the new students come in, we continue with the training. So we are reaching out to school level, basic school level, universities. And we will continue to broaden these initiatives. The objective, obviously, is that what we need is fewer and fewer people who are facing retirement saying that often stated, I wish I knew what I know now when I was in my 20s. The Financial Services Monitor is the natural next step for us in this process. The insights from the research will help Kenyans understand the forces shaping their financial decisions and help us to craft our approach to customers. It is telling us customers need help in crafting financial plans, and that can only be done through strong advisor-led solutioning, which again speaks to our victory condition. Financial education is a journey, and it would be unfair not to recognize the efforts of our regulators. I think you see before the 9 o'clock news on, I think, Citizen, there's almost every day an IRA ad. There's a lot of work being done by the CMA and organizations like the Nairobi Securities Exchange. I thank you all for coming and look forward to collaborating with you in enabling financial awareness so as to build more financially healthy and resilient households in Kenya. Thank you very much.
Thank you so much, Group CEO, for your remarks, reminding us the necessity of building financially healthy and resilient households. Family security, physical, mental health, and financial well-being don't change much as time changes. It's important to have an integrated financial services strategy, and that's what Old Mutual is offering its customer base. $12 billion worth of customer funds. There are economies in this region whose GDP is that size. 30,000 staff across 13 markets. That's quite sizable. We thank you so much for your insights, and we look forward to building on this. To continue further, and before that, the hashtag we are using to engage in this conversation on online platforms is hashtag #KnowBetterDoBetter. Hashtag #KnowBetterDoBetter. You can tag at allmutual_KE and be part of this on Twitter, Facebook, Instagram, wherever suits you. We are happy to engage you on that front. Next on stage, I'd like to invite Wangari Mwikia to give us a socio-economic overview. Wangari Mwikia is a seasoned public finance management, public policy, local governance, and economics. She is also the founder and managing director of Expertise Global, a public finance management firm that provides advisory services with a focus on delivering solutions to enhance public service delivery. Wangari, please, welcome on stage. The floor is yours. Let's appreciate her as she makes her way to this platform.
Thank you, Julians. I'm going to try to time myself so I don't go over time. So it's very strict on time, and I know we started a little bit late. Okay, thank you, and good morning, everyone. I hope you're all well. My name is Wangari Mwikia. As introduced by Julians, I'm a public finance management economist and managing director at Expertise Global. So as I start, I'd like to begin by thanking Old Mutual, our esteemed panelists, and the guests of honor for being here today. I would like to extend a hearty congratulations to Old Mutual for the launch of the Old Mutual Financial Services Monitor. A lot of work went into it, and the results are as interesting as they are demonstrative of the current state of the local and regional economies. These results speak to the current condition of many Africans, and more specifically for today, to Kenyans as they face the relatively harsh realities of the economy. Today's audience, it's safe to say, as I've been advised, is comprised of some of the movers and shakers of our economy. So insurance and bank regulators, stakeholders in the financial industry, government representatives, insurance brokers, agents, the media, as well as customers of Old Mutual. Thank you for being here today. So as they say in the good book, my people perish for lack of knowledge. And today, my friends, Old Mutual Financial Services Monitor, it's kind of like a tongue-tied, is ensuring we survive. The primary objective of the OMFSM, as it is called for short, sorry, someone's trying to call me, is to understand the working population's financial behavior, perceptions, and attitudes in Kenya. This study aims to provide the consumer context and texture by delving into how consumers are reshaping their relationship with their finances in these harsh economic times. This study provides a snapshot of Kenyans' financial behavior, providing essential insights that will help Old Mutual to collectively drive financial well-being in our country and create financial wellness journeys for customers and clients as the needs change over time. As we all know, and as mentioned by the CEO, Old Mutual offers insurance, savings, investments, and banking solutions to help their customers achieve their personal and business ambitions. So my job today is to couch the OMFSM in the context of the economic happenings in Kenya today. From the perspective of Expertise Global, where we work towards a world where public services enable citizens to reach their highest potential. So let's start with the basics, so that we all move together. So what is an economy, and what is it made of? According to the simplified version by the IMF, an economy is essentially a complex stream of production, creation of goods and services, and consumption, which is the usage of these goods and services, that allows entities to determine how limited resources are allocated. In other words, there's a finite level of resources. How we use them to create value and maximize utility determines how well we survive and thrive. So what is the Kenya economy then? When the OMFSM asked respondents how confident they felt about the economy, what were they referring to? Well, following the logic above, the basic Kenyan economy is made of, number one, what we produce, for example, tea, coffee, horticulture by farmers, tourism services by hotels and tour operators, banking services, insurance services from corporates like Old Mutual, Mabati suitcases and jembes by Juakali traders, amongst many, many others. Number two, what we consume, which are those goods and services produced locally and imported. And number three, the resources we have to do the same. Our land, our people, our tools, amongst others. There are many ways to measure an economy. The most known one is by GDP, which, to simplify one measure, is the total we produce, the total we consume, the total we invest, and the difference between what we export and import. Here, I pause to reflect on the fact that the OMFSM says that only 16% of Kenyans feel confident about the economy. That is 16% of Kenyans feel confident about how well we are creating value and maximizing utility from our limited resources. So what then is the current economic situation in Kenya? The Kenyan economy is growing, but it's growing painfully. The economy grew slower over the past 2 years, but it performs relatively better than many countries in sub-Saharan Africa. I want to contextualize this with three key figures. The first figure is 5%. This is how much the Kenyan economy grew, is estimated to have grown in 2023, according to the World Bank. To compare this number, this is more or less similar to the GDP growth in 2022, which was at 4.8%, but significantly worse than the GDP growth in 2021, which was 7.5%, but that was the post-pandemic rebound. So as a nation, we still grew, but our growth rate declined post-pandemic and has basically stagnated since 2022. So why? Remember we talked about production? Well, in 2023, the agriculture sector packed a punch because we had good rains. Manufacturing and services, though, depressed this growth because of higher input costs brought about by the weakening of the shilling. Consumption was also affected because local production declined. Because of the weakened shilling, imports were and continue to be more expensive. So this reduces our imports of vital inputs and products. The second figure is 160, which I know you're all familiar with and you know where I'm going with this. This is how much the Kenya shilling is worth according to the CBK compared to the dollar, which is a global currency of trade, otherwise known as exchange rate. So it's 160 now in 2024, but in 2020 and in late 2023, in 2022 it was 123 shillings to the dollar, and in 2021 it was 113 shillings to the dollar. So you can see it has declined, weakened significantly. So the shilling, why did it weaken? The shilling weakened primarily because the US Federal Reserve essentially reduced the amount of dollars in circulation by increasing their interest rates. So what does this mean? It means, in a simple way, that less dollars in the global market, there are less dollars in the global market, which simplified is when you reduce the supply of an item, the value increases. It also means that investment, which if you recall is part of the GDP equation that we talked about earlier, investment reduces because investors would rather put their money in US securities because they increase their interest rates. The Central Bank of Kenya has tried to slow the fall of the shilling by reducing the money supply in the market by increasing interest rates, but this has only worked marginally. But as a good economist, I strive to mention that there is an upside to a weakened shilling. It means that our goods are cheaper, which can increase exports. But this is tempered by the fact that to produce our exports, we need to import expensive inputs. Also, our international clients are suffering from the global economic slowdown, and they do not import as much from us. The third figure is 15.1%. This is how much tax is collectively being removed from taxpayers' pockets in fiscal year 23-24, compared to our GDP. This is almost 2% more than last fiscal year, 22-23. Now, if you compare this to the sub-Saharan African average, it's actually performing better. The tax revenue to GDP ratio is about 15.6% sub-Saharan Africa. If you look at Namibia, which is one of the comparator counties, Namibia is at 19.7%. But we are performing worse than Ghana, which their tax revenue to GDP is at 14.1%. So in Kenya, at 15.1%, which is up from, I think it was 13.2%, this upward trend is as a result of increased tax measured across the board from the Finance Act. If you recall, we had a lot of debate around this at the onset of the Finance Act last year in June, July. So income tax, VAT, excise duty, and even the legally contested housing levy, all of those are taking an extra shilling out of our pockets. This impacts both the formal and informal sector and people of all socioeconomic levels by reducing how much they take home and how much they can reinvest in their businesses. So overall, what does this mean? It means businesses are producing, but they're producing less because they have to pay higher prices to produce goods and services. Think high fuel costs, think of imported input capital like machinery. Those are all paid for in dollars, which is much more expensive. It means government cannot achieve its goals as exercised through the annual budget because taxpayers are not producing at good growth rates. And it also means that Wanjiko is consuming less and feeling the pinch because she has to pay higher prices for goods and services from her lower disposable income, although she has a little bit more in her pocket than many other of her colleagues in other countries in sub-Saharan Africa. So this affects market behavior in various ways. We have all seen the recent news, reports of landlords charging rents in dollars because the Kenya shilling continues to depreciate in value every day. Our public debt levels, which are dollar denominated, has increased, which in turn affects how much money is left to support Wanjiku's budget needs with government. Generally, life is becoming more expensive than we're used to, and we have to dig deep into our pockets to pay more and more for less and less. In short, my friends, the math is not mathing. But it's not all doom and gloom. But is it all doom and gloom? No, but with some caveats. Here are some additional socioeconomic indicators to consider from the latest Kenya Economic Update. Number one, the Kenya Poverty and Equity Assessment Report of 2023 says that children are achieving higher levels of education compared to their parents. And I think this links directly with what we're seeing in the Financial Service Monitor, the OMFSM. But the caveat is that this needs to be closely watched, because if the economy slips, there will be no jobs for them, resulting in unemployment and underemployment. Number two, good value-added growth from the service sector shows a maturing of the economy, which our economy has been primarily agriculture-based. What's the caveat? More has to be done to enable services to be more inclusive, to transition from low-skilled retail and personal services to higher-skilled financial services and even ICT. And number three, Kenya's overall human capital index is the highest in sub-Saharan Africa, meaning we extract more value from our children and youth based on our investments. The achievements in human capital reflect the government of Kenya's efforts in reducing malnourishment, increasing access to education and healthcare, and expanding social protection programs. And even as we're going to see, the retirement savings is low, which is one of the reasons we have these interventions from Old Mutual. Government policy is increasingly catering to the welfare of older persons, 68 plus, but it's not going fast enough. So we have the national policy on older persons and aging. We have the geriatric bill, which I don't know if it was passed. We have the national health sector services policy, which feeds into the essential packages for health. So there's things that are happening. There's an increasing recognition that there are enlarging groups of vulnerable populations from the elderly, and government is putting some effort to address this. Financial services, which most of you are here from, also continues to perform very well. Digital financial services have emerged and continue to gain a lot of interest, not only in Kenya, but globally. Right from the evolution of mobile money, I know every time we talk about mobile money, everybody talks about M-Pesa. I think we kind of get fatigued by talking about M-Pesa. But it is one of those things that we were global first and continue to be trailblazers. To the CBK discussion paper on central bank digital currencies, Kenya is at the heart of the digital financial services evolution. Further, according to the State of the Banking Industry Report 2023 released by the Kenya Bankers Association, the banking industry's total assets grew by 8.2%, from 6 trillion shillings in 2021 to 6.5 trillion shillings in 2022. And despite economic challenges in the country, the insurance sector showed resilience, with 14.8% growth in gross premiums from 88.4 billion shillings in Q1 2022 to 101.5 billion shillings in Q1 2023. But challenges do continue to dog the economy. Public debt soaring at 11.1 trillion shillings. Corruption continues to thrive, with many cases left unresolved satisfactorily. The threat of political instability creates jittery investors. further disillusionment from non-fulfillment of commitments to make early repayments on debt, which happens in December 2023. Underemployment, where we have highly qualified population, but they're not able to find work that matches their qualifications. That is starting to balloon. And policy and regulations can many times be incongruent with growth objectives. So as we take in the upcoming messages from the OMFSM, I want us to consider some questions for us here today. For the regulators, where does it make sense to regulate? And where does it make sense for the market to do its thing? How do you make space for innovation and change without stifling it? For the financial industry, financial services sector, and banking, including banking. With the increased interest rates for securities, banks are lending more to CBK, obviously. This decreases access to credit for the core class of individuals emerging as most affected, according to the OMFSM study. So how are we working alongside companies like Old Mutual to mitigate this outcome? Treasury and governance frameworks appear to have severe blind spots. What can Treasury do to introduce more controls within the MDAs, the ministries, departments, and agencies themselves? How can we enhance budget efficiency to provide for hurting Kenyans? I practice PFM myself as it's not as an end in itself, but to support the effectiveness, efficiency, and equity for every shilling that is collected by the taxpayer so that we can get the best goods and services to enable all Kenyans to achieve their highest potential. So the money that we pay the government in taxes, fees, and charges should be soothing where the shoe pinches. Brokers and agents, who are you selling your financial products to? And how do you meet them where they are in their financial journeys? I invite you to engage with these questions now and when you return to your places of work and over the course of this launch. But even though we're going through tough times as a nation, there are still opportunities to exploit. Kenya's participation in regional economic integration efforts, East African Community, we have the Africa Continental Free Trade Area. These can open up new markets and new economic opportunities. Infrastructure development can and is attracting more for FDI. Climate finance structures offer up new challenges, new channels, sustainably upgrading our infrastructure, and our youthful and growing population that can contribute to innovation, productivity, and economic growth through entrepreneurship, if invested in holistically. So the Old Mutual Financial Services Monitor plays a significant role in helping stakeholders navigate these tough economic times. I am encouraged that Old Mutual continues to prioritize the well-being of Wanjiko in the economy, and I congratulate you once again for sharing a study that empowers your customers in their financial awareness journeys. Your work aligns strongly with Expertise-owned company vision, which is a world where public services empower citizens to reach their highest potential. Thank you very much.
Thank you so much, Wangari, for those reflections and setting the socio-economic context to our next engagement. The last time I hosted Wangari on my show, it airs on Tuesday, every Tuesday on NTV. She was discussing the issue of the potential of launching a dollar-denominated bond locally. The next morning, I was firefighting with the National Treasury. Mic check. Thank you so much for that. So, next we have insights presentations, and it's being done by 3 individuals. So let me call on stage Voyukazi Mabude, who joined Old Mutual in 2022 after more than 13 years in the FMCG sector in leading organizations including Unilever and Pepsi. She brings with her extensive experience in consumer insights, both locally and globally, and prior to joining Old Mutual, she was based in London, where she was leading brand and innovation insights for Pepsi. You are welcome on stage. That would also be supported as she comes on stage by Anthony Mwithiga, who will also be joining us. Anthony, are you in the house? I saw you at some point, Anthony. Okay, I think he could have stepped out, as well as Nanzala from Ipsos. Just come and sit here so that as she does a presentation, we are ready to get going. So please, Wikazi, please come. This session should take 25 minutes, so I will be on cue.
Thank you so much. Good morning, ladies and gentlemen. It is great to be in Nairobi again. And my job is probably the easiest today. So I'm hoping you are patient with us. If you can't see very clearly on the slides, please don't worry, we will be sharing the full report. And my job, as I said, is the easiest. I am going to set the scene. As Julian has already introduced me, I am part of the team that's leading this work across the region. We have done it in Namibia, Kenya today, Ghana, as well as South Africa. So I will be setting the scene. Anthony, who hopefully will be back in the room in a second, will get under the skin of the behaviors of Kenyans in terms of their finances. And then finally, Nanzala will speak as our East Africa expert, just going into some of the insights that they have seen in other work that they have done. So let's get straight into it. Can I ask that you move the slides for us? I think the clicker, thank you. So just getting into the objective, and I know we've shared already in terms of the purpose of this work and the why behind this work, but I just want to reiterate, in terms of really what it is that we're after when we do this research. And the main purpose and driver behind it is to really understand people's behaviors and their attitudes to their finances so that we can help them get financially well. As I mentioned today, we're going to dig deep into specifically the Kenyan results. And please, can you move to the next slide for me? What makes this study unique is that firstly, it is locally grounded. We perform the research in a face-to-face methodology. One, this guarantees us the right quality of inputs from respondents, but also it guarantees us the right local insights that we need to make this work impactful. The second thing is that it's representative. So we look at a sample and an audience of people who earn from 12,000 shillings all the way up to above 100,000 shillings. And finally, it focuses on a key cohort within society, and that is people working in the formal and informal sector, which actually accounts for about 63% of Kenya's adult population. So it's very specific, it's grounded in a cohort that we believe are financially and economically active, and therefore we want to know what they're doing with money and what their relationship is with their finances. Please, can you move to the next slide? We're just going to get into a couple of trends from an Africa perspective. Okay. Next slide, please. Wangari gave us some great insights in terms of the socio-economic and macroeconomic factors that are at play at the moment. And I think to an extent, you can see across the board that low level of confidence in the economy is people experiencing the growing pains. It's not unique to Kenya. As you can see, Kenya does have the lowest confidence level, particularly amongst younger consumers aged 20 to 29, sitting at just 7% of people saying that they're confident in the economy. But as I mentioned, you can see that across the region, this is something that's consistent. And similarly on the next chart, which is actually partially a result and one of the things that's driving the sentiment around the economy, is what we call the financial stress measure. And if you can just move to the next slide. Thank you. And what you see here, so Kenya is the column on the far right. And so we ask people to rate their level of financial stress based on the various factors that they are facing. And as you can see, 48% of Kenyans say that they are overwhelmingly or highly stressed when it comes to their finances. It is only behind Ghana in this aspect, and particularly, which should be unsurprising, females and people who we term family providers, or people who are between the ages of 30 and 49, with families to take care of, are the ones who usually are the most highly stressed when we look at this data point. Next slide, please. Sorry, just one back. Thank you. So this term, I think, is a new language that we're using, but what it actually is not a new term. But this is what we're calling the sandwich generation. And what it is are people who have both child and adult dependence. Nanzala will talk a bit about what is actually driving the sandwich generation and some of the trends we've seen. But essentially, this is a very big trend across the region right now. And the big issue here is that these people are stretched very thin when it comes to their finances. Because you are covering, for example, medical expenses for a parent, you are paying education and fees for a child, and you are trying to maintain yourself as well as an individual, all within one income. And so this sense and the presence of the sandwich generation at 46% for Kenya is something that we're definitely going to keep an eye on. And when we do the study, again in the second wave, it's going to be quite interesting because we can actually trend this and see whether that's increasing or decreasing. But you can see in terms of the sandwich generation, just around half of Kenyans have both adult and child dependence, which impacts their finances. Next slide, please. With all of these challenges, unsurprisingly, optimism is really high. And this, I think, is super interesting because this is when we ask people about their personal finances. So not the economy, not what the government is doing. What do you think is going to happen with your finances in the next 6 months? And 75% of people are saying, I'm actually confident that there's going to be some positive shifts and I've got a positive outlook about what is coming. And that self-reliance and the entrepreneurial spirit, which we will talk about a bit in the presentation, starts to come through, and I think it's one of the drivers of this optimism that we're seeing. Next slide, please. Next one. Thanks very much. When we get into personal earnings, and I think we mentioned that we obviously, one, had a very wide range of people and incomes. We covered informal and formal sector. But one thing that is consistent is that 9 out of 10 people are saying that actually since 2020, so since the COVID pandemic, their income has either reduced or stayed the same. Now, in the context of the macros that Wangari spoke to, that means that people actually have less money in their pockets in real terms because the cost of food, inflation, etc., all of the things that they're facing now are having to come out of the same pot of money. So we think that this is quite important in terms of the shift in earnings. And again, this is one of the things that we will be making sure to keep an eye on as we continue to do the study. If you go to the next slide, please. And how people are making ends meet based off of that. So 9 out of 10, income hasn't changed. They're not earning any more. So what are they doing? They're borrowing money from family, from friends, from chamas, any way that they can get access to money from their savings as well is another big one. This is what people are turning to in terms of actually getting access to more money to make ends meet, is choosing to borrow money from the various areas that they can do that. So family and friends is a big one. Nanzala, again, will talk to this a little bit. Dipping into their savings, falling behind on household bills is also something that's now becoming a reality for a lot of Kenyans. And it really is important for us to start to have the right solutions and the right things that help to alleviate some of these pressures. The other side of the coin, if you skip to the next chart, please, is on a positive note, there still remains a very strong side hustle spirit in the country. We see it in terms of the business mindset, 54% of people saying that they own a business. On the left-hand side, you can see a little set of words. When we think about their finances, the first thing that comes up most prominently is business, so people are very business-minded. And then in terms of the term that will be new on that chart, which is polyjobbers, these are people who have more than one source of income beyond their regular job. So 22% of Kenyans are also now qualified as polyjobbers. So whether that is doing contract work outside of your day job, or a gig, that you're doing on the weekends, or driving Uber in the evenings, but actually working full-time during the day, this spirit of side hustles, finding ways to earn more income, is very much entrenched in the Kenyan society. And then finally, just getting into how people fund those businesses, it's interesting to see on the next chart that people are drawing from the same well. So even from a perspective of how they fund their businesses, they are dipping into their savings, they are financing them through any profits that come from the business, or using a loan from family, friends, a chama. And so again, that same pot of money and the same places that they go to make ends meet is where they go when they need funding for their business. If you could go to the next chart, please. Thank you very much. And with that, I will hand over to Anthony, who's going to take us through a little bit more detail in terms of financial behaviors.
Thank you, Vuyo, and good morning. Yeah, this is the nice part, financial realities. I'll take us through a couple of slides just to demonstrate what the Old Mutual Financial Services Monitor is telling us specifically for Kenya, and what are the realities from a financial perspective. Just to start us off is the priorities from a financial perspective in Kenya currently as listed there. So the top three are not a surprise. In the opening remarks of our group CEO, he had mentioned that these results won't be new or unknown, but they'll just reinforce what we know and put them in perspective. So for example, it's not by surprise that income security remains a top priority for Kenyans. It has been and it will continue to be. And this was properly tested during the COVID period. Cutting expenses comes second, and of course, third, paying debt. And it's a good thing when a country's people aims to be financially secure, deleverage, and pay for their debts. Because the financial services is highly patronized by, for example, lenders of all manner, from microfinance to formal banking, implying that the willingness to pay debt is good for financial stability of any country. But what is important for us, especially at Old Mutual, if you look at the last four top priorities, they really speak to what we stand for. Most importantly, enabling people to save and invest. And it's really imperative that 21% of Kenyans really prioritize emergency savings. 30% are looking for good returns. And the business I represent in asset management has that obligation at Old Mutual. But more importantly, the investments have to be secure. And as a financial services group, we do this by securing your assets through our various insurance facilities. But it tells you one thing in general. Financial security is key and top priority for Kenyans. If I move ahead and speak about debt, I think what we talk about in the country currently is the debt from a government perspective. But debt as individuals is equally important, and this survey has really brought to fore how we access debt as Kenyans. It's by no surprise through mobile money. I mean, we are the pioneers and heroes and kings of mobile money globally. And by extension, we should and we are expected to access mobile credit. Secondly, of course, from banking services. But one strange thing for Kenya, and remains very strong, thirdly, 25% of Kenyans continue to access credit through chamas or informal and formalized groupings, either of colleagues, family, friends, etc. It's not all lost from the banking industry, because a quarter of Kenyans continue to access, just a fifth of Kenyans continue to access credit facilities from microfinanciers and other financial institutions in the lending business. But more importantly, a quarter of Kenyans, or 24%, access credit from family and friends. And that's a challenge to the lending industry, to see why are family and friends good lenders, and how can that space be formalized? In general, 28% have a personal loan of any kind and nature. If I move ahead and speak more about debt and unpack the borrowing phenomena as highlighted by our Old Mutual Financial Services Monitor, loans are taken for business purposes as well as to manage unexpected expenses. This portends for us a huge opportunity and good news, especially when people borrow to start or to grow a business, implying money or capital is being sought to expand businesses. Of course, it's by no surprise, everyday expenses come strongly second as the reasons to borrow, including the need to meet emergencies. But one striking aspect of the borrowing phenomenon of Kenyans, as unpacked by the Old Mutual Financial Services Monitor, is that we also borrow to pay debt. Might find contradictory, but it's actually a good thing. First, we appreciate we have to live with some form of access to credit. And secondly, we understand how to exchange credit for any purpose, either restructured credit, cheaper credit, longer dated credit, etc. So it's not necessarily a bad thing to incur debt, to pay debt. It's part of our financial restructuring. But a key aspect of the borrowing from Kenyans as unpacked by this survey is that, and it has been mentioned by economist Wangari, is that education or schooling, whether paying school fees for higher education or tertiary and equivalent education ranks top priority for Kenyans, and by extension is being used as a reason to borrow. 42% of loans borrowed are actually being used to foster education, and that explains why the country continues to produce a lot of highly qualified individuals. But coming closely is medical expenses or health expenses. And this is a good and of course a worrying thing. You all know or participate in events to raise money for a sick family member or colleague or a friend, and it drains your pockets. But also importantly, it offers an opportunity for medical insurance businesses, including ourselves at Old Mutual, to narrow the gap and understand how we can make this easier for Kenyans. If I move forward, still on health expenses and medical insurance, one of the striking things is that though health wellness is very important to Kenyans, affordability remains a challenge, as half of Kenyans have no medical insurance. And medical insurance or access to affordable medical facilities is a big discussion in the country at the moment through various forms of public and private discourse. Strangely, two-thirds of formerly employed employees are not covered by their employer's medical cover. And that again offers an opportunity to all formal employers to raise up to the occasion and seek medical insurance for their employees, and by extension, a huge business opportunity for entities in medical insurance, including ourselves at Old Mutual. But what is more important from these results, especially in this slide, that 84% of citizens or Kenyans believe and continue to work towards being physically healthy, including mentally healthy. And that is a key requirement and a key ask for people in formal employment and by extension, formally employed and in business. Let me talk about savings and investing and investments. So for Kenyans, as explained by this survey, the top 3 saving goals are no surprise. Children education. All of you in this room, that must be part of your top 3 cost items in your income streams. Of course, second, money to start a business. And that ties to the very famous hustling culture within the country, trying to make an extra coin or an extra income stream. But more importantly, savings for emergence is a top 3 goal for Kenyans as depicted by this survey. If you look down the other 4 to 9, some of them stand out very strongly. And strikingly, I would like you to look at number 7 and number 9. And you might wonder why the roof on top of your head continues to struggle as a top priority, given the other pressing priorities for just to make the day-to-day living comfortable. From an entrepreneurial perspective, the fact that number 2 is money to start a business, but again, it's very encouraging that number 4 is further to develop one's business. That means the country, regardless of its current economic difficulties, the entrepreneurial spirit is still strong and pushing Kenyans to put priority in making businesses work and by extension have an higher or an extra source of income. Let me speak about retirement savings. Of course, as All Mutual, we are a huge participant in the retirement benefits industry because we offer these services to our clients. And this survey really reinforces our belief in helping Kenyans save for retirement. It's not surprising that 81% of Kenyans believe it's good to have a retirement financial safety net, even though saving for retirement doesn't fit or appear loudly in the top 5 priorities for Kenyans to save. If you look at your right of the slide, you realize that only 18% of Kenyans surveyed in this report actually belong to a formalized retirement plan or policy. Just 1/5 of Kenyans are covered by a product helping them to save for retirement. It's not surprising that the SACCO movement at 20% is slightly higher than the retirement access or products. And this is because the SACCO movement has the silver lining of its attachment to both access to credit and savings as well. So this push for savings in retirement is also telling us that there's a need it to be tied towards ability to access credit. Let me talk about hopes and fears about retirement. And this is extremely African, Kenyan, and by no choice, very well known to all of us in this room. It's not strange. The next slide, please. Oh, sorry. It's over here. Oh, thank you. Thank you. So it's up. This is a very good slide for us to reflect on because as I've spoken earlier, even though over 80% of Kenyans accept and meet and wish to have a safety net in retirement, and that talks about how high they hold comfort in retirement, their hopes and fears have changed over generations. For example, only 50% or 49% of Kenyans now believe their children will take care of them upon retirement. And all of you in this room should note that. So our children are not the investment we are trying to make them. Surprisingly, it's still high in some countries, both in West and Southern Africa, at over 70. Good luck to them. And the other startling statistic is about less than 15% of Kenyans believe the government will take care of them at retirement. And that brings to fore the need for financial services providers, including Old Mutual, to make sure that we work hard to improve people's savings on retirement and provide accessible and affordable retirement programs or savings. But another important aspect about hopes and fears of retirement, which this survey has brought out loudly, and I should repeat, is that it's a wish for every Kenyan to be comfortable in retirement. And that offers a huge opportunity to the financial services sector, plus regulators in the same sectors, to provide and increase both access and understanding of the products and services available for retirement. As I close, the journey to being financial well-being with the right advice is something which is quite low in the country. Close to 90% of Kenyans have no access or don't speak to an investment advisor when making financial decisions. And I must say, most Kenyans are extremely financially literate, especially through passing an exam. But they less consult a financial advisor, whether for an insurance product, a banking product, an investment product, a savings product, or even a credit product. And that provides the financial services group or sector with a huge opportunity to raise awareness. And I'm glad at Old Mutual we do this from as low as high school and above. Only 20% of Kenyans speak or have access to a financial advisor to advise them on their financial journey. I'll stop there. Thank you, and I'll invite Nazala.
Good morning to you all. Thanks, Old Mutual, for the opportunity to present at this launch. My name is Nanzala from Ipsos. I must say it's a pleasure to be back home. It's always a pleasure to be back home. And every time I come, there's so many changes. Yesterday, I was getting lost here around Upper Hill. There are roads that I had never seen before, and just getting lost. So there's always a lot of changes. But the one thing I want to talk to you about is the things that remain the same. There are some things that are consistent through time. We did a study in 2016, we called it African Lions, across 10 markets. And there's some things that are consistent here and across the region to varying degrees. So the three things I want to talk about is optimism, and we've seen the numbers on the optimism, the entrepreneurial spirit, and the other thing is the challenge of retirement planning. I mean, that has been consistent. Nothing has changed. In those, there are many other things that have changed, but those, nothing has changed. Now, in terms of optimism, there is, you see 75% thinking my financial situation is going to change in the next 6 months. And I just want to make it broader. Tomorrow will be better than today is actually the position of Kenyans, and really it is very optimistic. Tomorrow will be better than today. I am not a victim of the environment. I'm going to do something about it, very self-determining. But what drives this optimism? I think this is the question. What drives it? And you'll find that there's evidence of, it's because there's evidence. The tomorrow will be better than today is actually evidence-based. The first thing is that you'll see that people are borrowing from the family of from the bank. I call it the bank of family and friends because it's like the biggest financial institution. If you look at the loan book within your family or within your friends, you will see who owes who, how much, and who is, and who is repaying and who is not good, who I cannot trust. But if you look at that bank of, family and friends, people will borrow to set a business, you've seen it. People will borrow to take children to school and so on. It's because there is evidence that if you take your children to school and you give them a good education, they will have a better future. And we've seen the correlation in data between education and, being financial well-being or being, financially capable. We've seen that correlation, whether it's formal employment or business, but we've seen the correlation. So there's evidence of that. And because of that, then, there is that push for a better future. If it's not mine, it's my children who are going to have that fantastic, a better future. So there's that. There's also evidence of support. And this is the communal nature of Kenyans. So again, it's very almost acceptable to go to a family member or friend to borrow, to expand my business, to take my children to school, and so on. There's always that support. Recently, there was a family that raised, and for me it was quite surprising because I was in that WhatsApp group, raised 6 million shillings to take someone to India, one family member for treatment. And it is that support that actually creates the feeling that drives optimism. And I would dare say that if I checked amongst everyone here, you're on a WhatsApp group, one or another, raising money for one cause or another. It's because there's always that support. There's always the feeling of community, and that is what is driving that optimism. I don't know if we're on the... Just checking that we're on the right. Okay, yeah, we're on the right. We're on the right side. So there's that. So as much as we have got a lot of financial pressure, I mean, globally, there's inflation, but I think locally we've got other things to do with taxes, reduced income, and so on. There's still a lot of optimism, and just trying to, sorry. Just give me a minute. There's also evidence that hard work pays off. And hard work, whether it's at place of work or whether it is persisting in business or going to school to work hard for the future, that hard work pays off. And that also drives optimism. So generally for Kenyans, the optimism is driven by, it's evidence-based. Tomorrow will be better than today. We've seen people building homes one brick at a time. We've seen people prepare, taking children to school and having the next generation being better than the previous one. So that's the first thing. The other thing I want to talk about, if you go to the next slide, is about the entrepreneurial spirit. Now, you've seen this slide. There's a very high entrepreneurial spirit. This is the first wave of this study, but in study that we've done before, like 10 years ago and even longer, the entrepreneurial spirit in Kenya is not new. It's something that has been there for a long time. But what is driving or accelerating it is actually three things. One is the fact that formal employment anyway is not available to anyone. Only 30% of Kenyans have access to formal employment. 70% are either employed in informal business or are self-employed. So the fact is you do know that formal employment is not for everybody, so you actually start thinking, and now it is even earlier. People are still going to university and they're already thinking, what business am I going to go into? That's the first thing. The second thing is that the younger people are actually not willing to work, and if you talk to them, you'll hear it. They're not willing to work for the same organization for more than 5 years or 10 years, or until they retire. They're not willing to do that. So because of that, they're always wanting, and that's where the polyjob as the side hustle is accelerated. So there's acceleration of the side hustle because of wanting to increase your income streams, but there's also the acceleration of the side hustle because of wanting to have something else that you can go to, leave the formal employment. The third one is actually the gig economy. So again, the young people want to be in the gig economy. This is for professionals. They want to do, if I'm in data processing, I just want to do data processing for the different companies, but I don't want to be employed by one company. I want to do it. So it's also being entrepreneurial, but you're on your own, in the gig economy. And these things are actually driving the entrepreneurial spirit, very self-determining. You'll hear conversations about having more than 5 income streams, 3 income streams. Actually, we say polyjobbers almost sounds like it's like formal job and one side hustle. No. Actually, if you go in, you'll find that there's those who are saying 1 job and 3 side hustles, or I have 5 hustles, or like that is actually what it is. And it's to understand that this is the entrepreneurial spirit is really, really key. It's there and it's growing, and it's something that is going to be for a long time. And the third thing is I wanted to talk about, and just going to the next slide, is about the challenge of retirement planning. Now, there was a generation past who worked until they retired, didn't really plan for retirement, got their pension, went back to the village where you either had a home or maybe didn't, had no other source of income. I think this story sounds familiar. And in no time was dependent on their children. And actually, their children looked after them. Because all through their life, they worked very hard, they took their children to school, their children looked after them. Now, we are not in that generation anymore. You've seen 81% actually are aware and are quite clear that they need to plan for the retirement. We also know that 50% of us know that our children are not going to look after us. There's also something else, and this is what this slide is all up about. If you see at the point, retirement was number 9 in priority list, not because it's not important, but because of the other pressure. But if you look at this chart, retirement comes up to 4th place at 50 plus. It's a little bit late. Like, you're there, struggling a little bit late. But I want to talk a little bit more about the sandwich generation. That generation is growing, and it's actually because of 2 trends. And these trends are global trends, but they also affect us here. The 2 trends is the increased, is the fact that we're living longer. So our life expectancy has moved up. So I think it's moved up to 60 to 50 something right now. It will be 75 by the year 2100. So we are living longer. So what is happening is that you are looking after your parents long into your own retirement. So you retire, but your parents, you're still looking after them. So there's that part. That's the one side of it. And I wish it was just that one side, because that's the good news. The bad news is that the children are not getting independent fast enough. So in the years where people would get, and if you think about it, is there was a time it was you leave home at 18, you go going, don't come back. And then it became around, you will finish university and maybe we'll look after you a little bit for 22, 23 years and you will get independent. But lo and behold, now it is 26. Now it is 28. So what's happening to these people in the sandwich generation? You're looking after your parents and you're looking after your adult children. And these children are needing quite a bit of money from you because they are in the city, or they are studying somewhere, or you're taking them. So there's quite a bit of financial stress at that point. You're also trying to put the permanent, that house you've always wanted to build for yourself. Now that's the time you want to build it. But lo and behold, there's this drama here. This is the time you want to plan for retirement, but here is the pressure in front of you. You want the best for your children. So that creates quite some tension in terms of that sandwich generation, and it's going on. But this group of people need the retirement planning more than any other because, as we said we think 50% think they'll be looked after, and as Anthony said, we wish them well. I think it's actually evidence that we will maybe be looking after those children. So there's quite a bit of pressure within this sandwich generation, and the retirement planning is actually continues to be a challenge. So in closing, I just want to summarize what we've been saying, the 3 of us. If you go to the next slide. In closing, we are saying despite the huge financial stress, Kenyans are still quite resilient, and the optimism remains. I think it's quite positive. Resilience, optimism, those are really positive things for us. To make ends meet, we are managing our finances through borrowing. It's a fact, we've seen it. The entrepreneurship and the side hustle and the entrepreneurial spirit is really part and parcel of Kenyans' lives, and it is growing. So even those who have an opportunity for formal employment, that 30%, are still saying, I need to have a business on the side. Funding to start a business or to expand a business from savings is actually a big thing, and it's a positive thing. the importance for retirement planning is acknowledged, but we know that there's not much that is happening there. And we know that financial education and access to financial advice is critical, because if you look at it, if we needed to, we were talking about it earlier, if we needed to raise money quickly for an emergency, we can. So the money is there. If someone needed to go to hospital, we can raise that money very quickly through our community, chamas, everything. There's money in there. So what we need is actually to find a way to manage it. So in conclusion, I would say Kenyans are highly optimistic, entrepreneurial, and communal. This dynamic can be harnessed for better retirement planning and financial well-being in the long run. I mean, it also, it doesn't have to be from the sandwich generation. It has to be from much earlier, as we said. Thank you very much.
Many thanks, Vuyo, Anthony. Just remain seated here. Just remain seated, because there's a panel and you're part of it. And Nanzala for that very illuminating insight session. And that's a good segue to get into the panel. I'd like to request my tech team at the back to help me move this podium from here so that we have good view of our discussants here. A lot to unpack there. I'll just mention that as we get into the panel, 2 years ago I was hosting a conversation around preparation for retirement. And whom was I hosting? I was hosting Geoffrey Odundo's brother. His name is Dr. Edward Odundo. So we had a 30 minutes conversation. And one of the things he said was, when you're going to retirement, you need 5 things. The first one is not even pension. The first thing you need is a medical cover. Because when you fall sick, you realize how expensive Medicare is. The second thing you need is to ensure that you've paid all your bills. The third thing you need is now that pension you're talking about. The fourth thing, find a hobby, start a business or something which keeps you engaged. I forget the fifth. That clip went so viral. We were receiving forwards from as far as Japan and Australia of that clip. It ended up being part of what helped us craft the digital strategy for the Nation Media Group, because it was so powerful, it was so potent. I can only imagine what this kind of engagement can elicit by way of attraction online. But let's get into the panel, and I'd like to invite to join my panelists already seated here, Arthur Oginga, please come on stage, as well as Wangari Mwikia, please come and settle somewhere, I think on that side. This discussion should take about 20 minutes, and then I shall open for Q&A. So please have your questions ready so that we dive into it right as soon as we are done here. So we've had the scene setting. We've listened to the insights presentation. I'd just like to kick off with Arthur. And the question here is, according to the results, Kenyans have dedicated their savings toward putting money aside to start a business. It does seem that the spirit of entrepreneurship is alive and well in Kenya. What would this mean for Old Mutual?
First of all, very pleasing that saving is one of the top 5, at least saving for your business is one of the top 5 priorities for Kenyans financially. Augurs well for financial services businesses. I think some of our most successful economies, in fact, most successful economies, are actually driven by small businesses. So I think this is very positive for Kenya. But what does it mean for Old Mutual specifically? Old Mutual, we have, as I mentioned, we have 4 different business lines. Faulu serves all the way from the micro segment to small and large local corp.
Thank you, Anthony, for your introductory thoughts. Let me come to Vuyo right next to me here. The research indicates 46% of Kenyans are in what has been termed as the sandwich generation. Could you give us more color into what really characterizes this generation?
Absolutely, and I think Nanzala captured it really beautifully, but I think the biggest thing is just how stretched that generation is, and we've spoken to it. You have the pressure of elderly parents, older children who are still dependents, and you have children dependents as well. And so this is characterized by, I think the easiest word to use is stretch. So if you think of an elastic band, these are the people who are just continuing to have to stretch and stretch and stretch, making ends meet on a day-to-day basis, supporting community, family, etc., from an adult perspective, and also children. And I think the real opportunity that we have with now knowing what we know about this generation and illuminating what we know about them is how do we better serve them? How do we create products? How do we have, as a financial services sector, the right solutions to actually help enable them to save? And Arthur spoke to this. Saving is a priority for them, but with all of the stretching, does it fall aside? So I think that's the real opportunity, is how do we solve for their challenges? We understand the tensions, we understand the challenges that they're facing. How do we start to build solutions that actually serve that particular generation?
So we can tailor-make solutions to harness the opportunities being presented there. Anthony, with the positive outlook on personal finance futures, how can individuals make informed investment decisions to realize their financial goals, especially in the present economic situation?
Thanks, Julian. I think it's actually very encouraging that the top three intentions of Kenyans financially, savings, savings either for a rainy day, to start a business or to grow a business is a big part of their priorities. But one of the key things which we strongly believe that enables individuals, Kenyans, young and old, to have a successful financial journey or wellness is, first and foremost, is to educate themselves, because that enables you to interpret and understand financial products offered by financial groups like Old Mutual or ourselves. So that is key, and that's, Julian's, that's why at Old Mutual we spend a lot of time and effort and money to take the huge responsibility of financial literacy. So and the second part is, after being educated or being knowledgeable, is to be gainfully engaged, whether through a formal employment or informal employment, a job or otherwise. And you can see from the survey today that polyjobbers, side hustling is critical to a formal employment. Now, the third and final thing for Kenyans, our customers, our clients, etc., is now to commit a substantial part of that income to a day in the future, either by accessing a savings product, an investment product, or a retirement program. So it's about educating yourself, being gainfully engaged, formally or informally, and thirdly, starting to access an investment or a savings products as early as possible. Thank you.
Thank you, Anthony. Polyjobbers, what a swanky name for side hustles. And maybe that's a good point to come to Nanzala. When you talk about the side hustling trend in Kenya, do you think this is something that can grow in the country and to be a substantial part of the economy? And we are thinking about this within the context of a government which is really struggling with tax revenue, and of course it wants to reach and extend to that part.
So I think first, it's a trend that has been there for a long time, growing. And it is also going to grow even further. I just want to just compare a little bit with South Africa, where I think if you looked at South Africa 20 years ago, polyjobbers was just not a thing. But it is now. So I think it's driven by several things. One, the need for additional income streams. But then there's a need to secure your income stream. And it almost feels like securing it would be securing it by having something that you're doing, that you are determining. You're really going about it. You know, you're in school, but you're already doing something on the side. You're employed, but you're already... So this is going to grow. And of course, as a government, as you know, I think it would be, as a country and as the government, it would be good to actually facilitate and appreciate that aspect. I think even as employers, it would be good as employers to actually have an acceptance that this person has a side hustle. I think it's good to be open about it. We did a check in the business, I think it was a few years ago, where we checked what other things do you do. It was very interesting. Like there were so many people doing, there was musicians, seamstresses, and so, I mean, we are researchers. It was very interesting between researchers and musicians, a very close linkage, but they are there. So I think it's something that is really going to grow, and it's there, and across the continent to varying degrees, but it's there, and it's across sub-Saharan Africa.
Nanzala, maybe a quick write to that. As you say, we need to embrace it as employers. Are there any productivity trade-offs that are involved here?
Involved in that?
That you embrace side hustle, but it means I'm giving less to Nation Media Group, for instance, as I do other things.
No, actually, I don't. I think it's what would I want to call it? It's burying your head in the sand. So whether you accept it or not, it's happening. So, but it's just that if you look at the side hustle, I think there's that energy. So some people are doing things on the weekends and so on, and it's accepting it within of course I don't think it would reduce productivity. I think it would make the person feel more endeared to the company because you also appreciate what I do on the side, even though it shouldn't be affecting your day-to-day job. Yes, I think it's actually there.
Thank you. And let me just come to Wangari on that point. Are there any policy interventions that we can adopt as a country to facilitate what Nanzala is speaking to around the side hustles?
I think the question, even as I was hearing the presentation, there's also this group of people who have side hustles primarily because they were not able to do the thing that they really wanted to do, right? So, and that speaks to an economy where you don't have a diversified set of sectors that are well income generating. So you find someone who's a lawyer because, you have the typical lawyer, engineer, doctor. But this person really wants to be an actor or something, wants to be something else, wants to make crafts for that reason. And so you find someone has their main job, but they also have a side hustle that is not necessarily because they are trying to generate income, but because they have a different passion. I think that also speaks to a separate part of how this side hustle thing works. But coming back to your question, in terms of how the government can support entrepreneurs, I think that was the question. There are several ways. I think we have some that are already operating in the economy. So you have funds where government are providing funds for businesses to, get loans, get grants to start to get capital to start their businesses. But sometimes these funds, like WESO funds, youth enterprise development funds, they're hard to access. They're not very straightforward. Nobody knows where to go to access these funds. So even just the accessibility, the applications, the process can be very bureaucratically challenging and can be really opaque in terms of how you access these finances. So I think, and sometimes we also complicate things, in an effort to be, on the digital forefront. You find, I've been seeing a lot in the papers how people are, instituting these kind of digital applications, digital payments, without really considering whether the people who use those services are actually able to access those platforms to be able to access those services. So I think overly complicating things is one thing that we need to make sure that we don't do. Reducing barriers to entry, reducing tariffs for small businesses, which I think in Kenya we've not been very good at. Infrastructure for MSMEs, what kind of businesses are there, what kind of, infrastructure, both physical and otherwise, can we provide them so that we can provide them that boost? And then also financiers, people in the financial sectors, how do you incentivize them to concentrate or to provide resources, access to credit for entrepreneurs who need the capital to boost their growth?
Thank you, Wangari. Wangari said one of the reasons why people get into side hustles is because they weren't able to do what they really love to do. That's the story of my life. Trained in finance, but here I am. Arthur, one of the issues which has emerged is that Kenyans take loans for medical expenses. What does this say to you, and what are your thoughts around this?
First of all, I'm very happy you didn't ask me about my thoughts on the individuals doing gigs in Old Mutual. We accept and acknowledge. First, I think I empathize. We have medical expenses are very high, and of course, illness doesn't tell you I'm coming in 2 months. Prepare. So you have to be ready. Historically, we've had the Harambes. A couple of weeks ago, I told a friend of mine who was talking about Harambe, I said to him, if you don't have, what is that place near KICC? And this is going to show age. Garden Square. If Garden Square doesn't exist, I'm not coming. So we had Garden Square Harambes. Garden Square doesn't exist, I'm not coming. So we had Garden Square Harambes. It became technology different through WhatsApp groups, which became very efficient. But to be honest, we are all trying to say, it's enough, it's tough. So there's no other route other than medical cover. I mean, that really is the only way you can protect yourself. Not just yourself, your side hustle, your business, your job. You cover yourself through taking medical cover for those uncertain times. There is growing awareness. I mean, certainly medical is one of the fastest growing classes of insurance. So there is awareness amongst Kenyans. And we are seeing the efforts by government to provide increased health coverage to those who cannot afford. Finally, I think one of the things that makes health a problem is really the cost. And working together with the partners in the whole healthcare chain system to reduce the cost of illness and accidents is important for us as Old Mutual and for the industry generally. Thank you.
Thank you. Thank you, Arthur. Sorry for that. Anthony, just on that point still, the report indicates that 9 out of 10 persons have not seen a change in their earnings. And I'm wondering, as an investment professional, how should individuals adapt their strategies to this reality?
Yeah, thanks. I think one of the things we've seen, and it's encouraging, is actually, if you realize savings with a component of investing has really picked up post the COVID pandemic. And of course, for the benefit of this room, savings is not investing. Savings, you just want money to be available when you need it, as safe as possible. So in savings, its safety is key. But in investing, there's an implied risk for the uptake in return you're looking for. So what we've seen, especially in the medium age generation, formal and informal employed young people, mostly below the age of 40, there is really increased appetite for risk. And some of the more sophisticated, complicated investment solutions seem to be highly lucrative to that group, especially the one between 25 and 35. And the reason for that is because there's an implied fatigue with the traditional investments, which have been mentioned. Buying bonds, placing money in a bank deposit, buying treasury bills. Sorry, Jeff, investing in the stock market.
Why are you sorry, man?
Because, yeah, it's not being classified as old-fashioned. and the reason is because there is new age investing for higher return is accessibility, which the financial regulators are running behind time to formalize, to regulate and the working community. With side hustling and people doing double jobs, by extension, by the way, there is some signs of extra income. Look at 2024, January, the month just passed. There was less, what do you call those things people send on WhatsApp groups which have images?
Memes.
There were less memes of January or of a difficult January. And from where we sit as a business, we actually had a huge inflow of savings or of pickup of investment products in January. That tells you there are signs of propensity to save, even though it's difficult to earn an extra income. And for that reason, as an investment community or professional, we have a challenge to make three things clear. One, accessibility of those products. Secondly, knowledge about those products. And thirdly, and most importantly, entry level or affordability at any level. In fact, the challenge we see, all investment products of financial nature should not have a minimum entry level. Should be 0 to infinity. Thank you.
Thank you, Anthony. And when you talk about knowledge about those products, that's why I come to Vuyo right next to me here. Where can people access this wealth of information right from the monitor we just launched this morning, as well as the products now he's talking about?
That's a great question. So the report will be made publicly available. It will be on our Old Mutual website. And it does, and I think just to assure Arthur, the people who are polyjobbers are working right now on their phones in this room. The side hustles, they're selling stuff from their phone, arranging delivery for later today. We've got some really great insights on things like digital and how people are earning money through digital channels. There's a lot of things. Obviously today we gave you a quick snapshot and a tour through the work, but really there's so much depth and so much more knowledge that you can get. So it'll be available on our website. And I think what's really exciting for us, with this study is starting to see it come to life. So putting it in the hands of our customers through the right kind of financial advice. Our advisors get access to this. The partnerships we start to make with policymakers, with the other partners within financial services, starting to actually use this. The Department of Treasury has used this work. In Ghana, for example, there's academic institutions that are using the work as part of other studies to help them understand some of the debt phenomenons that we uncovered there. So really, I think the possibilities are endless. It's exciting because this is just the beginning and today is just the launch. But what we actually want to do is to start using the data and using the information to have the right conversations that actually help our customers become more financially well.
Thank you, Vuyo. I want to ask the panelists two more.
That actually help our customers become more financially well.
Thank you, Vuyo. I want to ask the panelists two more questions, and I come to Q&A. So if you have a question, just be ready. My team at the back, I hope we have some roving mics, which will be able to circulate. The first question goes to Nanzala, and there seems to be a commonality in the study of people borrowing from family, from friends, which I believe we are all familiar with as Kenyans. Are there some inferences that could be made from this regarding people's borrowing preferences? The microphone and so on.
I forget. Yes. I think the issue of borrowing from family and friends has got two sides to it. One is that it's really built on the communal nature. So we already have that Harambee spirit, helping each other. So it's easy. It's almost a circle of trust. So it's a place where it's almost not odd. It's not odd to actually go and ask someone for a loan to take your child to school or to finance your business and so on. So it's about a circle of trust. I think the other thing is lack of access. So you especially for personal loans, and if you looked at the charts, you would see there's lack of access for personal loans. So if you want a loan if you want a mortgage or whatever, those types, maybe there's a bit more access, but how many are those But for a personal loan, it's lack of access. So you would find that it's easier to actually borrow from family and friends. And then, of course, there is no interest, repayment.
It's something.
Chama is a little bit more formal. So I would say the chamas are a little bit bigger than family and friends.
Yes.
So chamas have become quite formal, the investment clubs. I mean, the whole chama thing is quite interesting because there's welfare, there's lending and borrowing and real business where there's penalties and everything. And then, so I think that's a little bit more formal actually than family and friends. Yeah.
Yes. Wangari, before I come to the floor here, so the survey shows there's a very low uptake of retirement savings products in Kenya. What would you say is a long-term solution to this? And what are Kenyans who are not engaging in this long-term savings plans foregoing as an opportunity cost?
All right, thank you, Julian. And I think even just before I came, I just wanted to make a quick comment on, I was contemplating.
Does Wangari's mic need a boost?
Hello?
Yes.
Or maybe I just need to speak louder. Contemplating, and I remember from Anthony's presentation about 9 out of 10 Kenyans, I think it was, don't have a financial advisor. And the idea that people actually decide whether they're going to have a side hustle or they're going to have an investment product, right? So they decide, with the little income that I have, I'm going to put it all into the side hustle, or am I going to diversify it? And I think that's an interesting thing, whether they're actually substitute side hustles and investment products. Are they substitute or they complements? And the value of having a financial advisor to provide that insight. Another quick thing is that the idea about universal basic income, it was run in some sections in Kenya. And it was quite surprising that one of the things that people were using, you get a cash transfer to use on whatever costs that you have, and you decide what those would be. A lot of the Kenyans, what they were doing is that they were a large proportion of the income that they received, the universal basic income that they received, they were using to provide to finance funerals or harambes and those things online, which is quite surprising because you would have thought that people would use it for their own kind of basic needs. But then that speaks to the fact that people do see this as a basic need, like the social contract that you have when you contribute, that when something does happen to you, it's like an insurance product that people will contribute to you. So they really prioritize providing, donating and giving money when people are in need. So I thought that was quite interesting. But back to your question about retirement savings products. I think the opportunity cost is borne by the young people, right? Because if they have, with the resources that they have, they are using that now to support their elder relatives. But it's also interesting to think about it the other way. Like, I have 3 young children, and I'm spending a lot of money raising them. So many things. You almost see that as, because it's a priority, you almost see that as an investment. So you can kind of see why people think, like, if I put all this money that I could have used for something else in my children, then ipso facto that they would, when I'm, older, that they would invest in me. So there's that kind of idea. It seems to make sense, but we need to kind of disabuse people of that notion that you have to take care of your children, but you also have to take care of yourself when you're older, because you don't want the people call it the black tax, or caring for people when they're unable to care for themselves. But then there's also a cultural aspect, right? So we see ourselves, many Kenyans see themselves as being responsible for their immediate and extended family, and that's something that is part of the culture. Healthcare and other related services also miss out on opportunities, because if there were savings, people were putting money into retirement funds. That capital could have been used in the healthcare sector to provide additional services, additional products that then would help diversify the retirement, the retirement condition. And then I think lastly I wanted to comment, because I remember very starkly that image of Namibia and Ghana. Think about 70% of people think that their children are going to take care of them, and then about half of Kenyans think the same. I thought that was quite striking, because 50% is still high. But yeah, like you said, good luck to Namibia and Ghana. And then the 14% are really the Serikali's idea guys who are saying, you know, the government is going to take care of me. Which is actually, you know, government, that's part of the role of government, right? But at the end of the day, we know the country we live in. We know we're probably not going to be able to access a lot of that financing. So yes, these products are essential.
Thank you, Wangari. Speaking about Kenyans and pension uptake. I was once naive enough to go on Twitter and say that I'm actually in support of the NSSF Act of 2013 and the provision of the bump up to 6%. My friends. Kenyans on Twitter came for me. But really, if you do the math, 200 shillings, I mean, even if you did it for 50 years, it was really coming to nothing. Any questions from the floor? Please just shoot up your hand and we'll be happy. Oh, there's a question here from Jeff. And to whom you're directing, I suspect it's to Anthony, now that you mentioned the NSC. There's a mic there, Jeff.
I've talked to him too much. I don't talk to him. I'm just keen on the sandwich generation. I think I happen to be one of those. What has led to the growth of this segment? Because it's very evident here in Kenya. I was just sharing with Arthur that I'm also a victim of that generation, and how do we get out of that trap? And the second thing is around what else can we do to entice the youth back to come to investments? I've struggled with that for quite a long time. I just recall that Kenyans were very interested in psychology. We had something called the quail egg psychology in this country. I don't know what happened, but everybody was raising quails and getting eggs. Is there something we can learn from that? I don't know whether we can.
Any other question before we respond to that? There's a question from a gentleman at the back there. And please introduce yourself.
Good morning. I'm Kenneth Epukulu. I'm a media practitioner. My question, it can be handled by any. Like corruption in Kenya is traceable to the Ndegwa Commission that allowed civil servants to engage in private business. Have you considered the negative effects of the practice on loyalty, basing on loyalty to work and corruption, especially in the public sector? Thank you.
Thank you. Side gigs, the trade-offs I was talking about, and especially in the public sector, that's a question being asked. Any other before we respond to those two? Okay, we can take. Oh, there's a question, there's a hand here, sorry. Yes.
Thank you very much. My name is Daniel Mainga from Minet, Kenya. I think my question can be taken by anyone, Anthony maybe, but I still struggle with, because I'm in the same space with Anthony. We've really struggled as an industry to get the informal sector into to get them into the savings culture. These are people who are doing businesses, not just side hustle, but they are day-to-day businesses. But really, the savings bit has been a challenge. Other than the businesses they are running, which are successful, they still don't see the need to put aside, some funds for a rainy day. And really, that has been a challenge for us, despite having come up with several products, like the individual personal pension plans, and even investment products. So really, what are your thoughts? Thank you.
Very good question there. We shall take those three. So Jeff began by asking, how do we navigate this sandwich generation trap? Arthur, you look inspired to go for it.
I don't know why I got picked, huh? So I think the sandwich generation it's a reflection of the last slides that Nanzala actually put up. When do you start thinking about retirement planning, right? So that, Nanzala used this hand for the older ones. So our parents retire and they haven't prepared adequately for retirement, so you have to take care of them. On the other side, I think it's just a reflection of our economy and the state of growth and employment, education, et cetera, et cetera. So that's a factor that is increasing the length of time people stay at home before they go up, branch out on their own. Although there are a few notorious ones who just do not leave. So I think that is what's driving this middle part. And also I think for the younger generation, this phenomenon of gig work kind of makes them, it's not regular income, so the safety of staying at home could be a factor. What do we need to do to get this thing sorted? I think what we said earlier, and I think if there's one slide we should take home with us, is the one that says only 12% of Kenyans have financial advisors. Now, when somebody says, have a financial advisor, it's free. At least it's free at Old Mutual. A financial advisor just talks to you about your financial goals, helps you set your financial goals, right? What do you want? Where do you want to be in 2 years' time? Where do you want to be 5 years' time, 10 years' time? In the short term, what are the things that worry you? So you're employed. If you lose your job, do you have money that can take you 6 months, 12 months? Where do you want to be? So those are the kind of conversations you will have with your financial advisor. That, I believe, is the way we should start getting out of this sandwich status. So, Jeff, I will not loudly say that I am in that category in case my mother hears. But I think the nature of the economy, we are getting more urbanized. We are going to have to start planning and thinking about our financial goals a lot earlier. Personally, I always say, I wish I knew what I know now when I was 20. I would be a lot wealthier. Well, I'm not even wealthy. I would be a lot better than where I am today. So the work that Old Mutual is doing around financial advisors, I think, is the route to go to get out of this trap. Thank you.
Please.
Thanks so much. So thank you for the question. I think there's two things just to add on to what Arthur was saying. The first, I think, is we have to recognize that there is an emotional component to the sandwich generation. And it's not always a negative thing. I think sometimes when we use the phrase, people might think, oh, yes, there's tension, yes, there's a stretch. But a lot of people are very proud of being in the sandwich generation. And so I think there's also that to consider, that with the emotional dynamic that comes with it, you will always meet the needs of adult and child dependents in your family. And so I think there's an important element for me in terms of being anchored in your financial reality and the emotional component of that, which is unfairly is not there when it comes to insurance or investments. You don't feel bad if you don't pay your car insurance. You will feel terrible if you don't contribute. Nanzala, I don't know how many WhatsApp groups you're on, but so I do think that there is an important emotional dynamic and motivation to the sandwich generation and what they do. And it's important to remember that and kind of be cognizant of that. And where financial advice plays a part is taking that and adding onto it and saying, okay, if you want to be able to do these 10 things, here's how you can set up your finances to be able to somehow meet those needs or the dynamics that you have. The second part, I think, is that with the evolution, I guess that we're hoping in the next years, obviously, as we continue to do the study, we see the trends. But I think, as the sandwich generation themselves evolve, it is planning for the life you are in, not planning for an aspirational life that isn't a reality. And by that I mean, to Nanzala's point, if you're currently in the sandwich generation supporting parents and children, you can't plan for a retirement where there's suddenly no one to support in 5 or 10 years' time or 20 years' time. So I think it's important for people to also be anchored in their reality, get the right financial advice, and bear in mind that there will be an emotional dynamic at play when it does come to the sandwich generation. And to your second question in terms of how do we get the youth interested in investments, I think if we can answer that, we would probably be in Arthur's wealth segment. But I think the big thing is really starting to help young people see beyond today. And I think part of the challenge of making ends meet kind of, short term, and it's not by design, it's literally circumstance. People are very much trying to make ends meet for today, put food on the plate today, therefore they're not thinking about tomorrow. And I think the job as financial services, government, etc., the various people in the room, is starting to help people see that there is a future that's worth saving for, that's worth investing for, rather than letting them kind of just stay in the reality of today. There is a job for us to do to say, actually, in 10 years' time, this is the picture of what your life could look like if you're starting to invest. So yeah, I think the big thing is, do we have an answer? Not quite. There's a lot of work to do, but I think the starting point is helping people to see beyond what their financial reality is today and how they can actually start to work towards a future where they have savings and investments.
Thank you. Wangari, very briefly.
Just a quick one, and I think along the lines of what we were talking about and what Anthony was talking about, where you plan for the life you're in, and then what you commented about, if you knew what you knew when you were 20 years old, now when you were 20 years old, you might have done it. You might have been in a better situation. I don't know if that might actually be true. I think there's this concept of, in economics called the hyperbolic discounting, which I know many of you know, where you place a lot more value on today than 10 years from now. So even if you try to convince these young people, 10 years, you need to, you'll be very happy with your savings today, it's unlikely that they make that leap. So my thinking is that maybe you make a product for their needs today, their priorities today. If they want to be going to the equivalent of what was Carnival in my time, I don't know what it is now, make it a hanging fund or something. That's a convertible fund into something that when in 10 years' time, they'll be like, oh, actually, I have this pool of funds that now 10 years later, I can convert into something more that makes more sense to me. So I think kind of speaking to the reality of what we know, you guys have been in this business for a long time. I think we kind of know that young people don't really think about this. But then even speaking about the Gen Zs, I think when you said Gen Zs are retiring, the Gen Zs are retired. They retired after the 3 months on the job. Yeah, they are like, yeah, I'm done with this job. So I think they have a very different way of thinking. They have they want to live at home. They have very limited living costs, and whatever money they have, they want to travel, and they want to have maximum enjoyment. So we have to think about what products that they need. I think they'd be very different from the products that we would need or we would have wanted at their age.
Thank you, Wangari. I wish you had more time for that conversation on asset classes because I've got very strong views and I've shared them with Jeff. I began investing in the stock exchange at 18. Today I'm 34 and I asked him, is the NSE a value trap? Because man, it's been a long wait. There was a question, Nanzala, on the trade-offs, especially if I have a side gig, I'm in the public sector. What does that mean?
So I guess I sort of put myself in it. But I think if we look at it from just employers in general, in most employment contracts, there's that part that says you should not do things that are in competition with your main job, and you should not do, I think there's ways of dealing with it so that you do not, for example, in government, be a provider to government, providing services when you're already working there. And I think when I think about the people now I'm thinking about respondents, because being a researcher, you have to go back to what is in research. If I think about the research and if you think about respondents, you'll find that many times the side gig has nothing to do with their main job. So someone works in research, as I said earlier, and they are a musician. Someone works in HR, but they are a seamstress. We had a data processing person who did wonderful baking. So I think it's about separating, and maybe for employers, it might be about being very clear that there cannot be conflict of interest. I think that's the main thing, no conflict of interest, and also that it does not conflict with your job. In South Africa, I think, I've not been here for long, so I don't know if it's happening here, but in South Africa, there was also a bit of open space saying you might want to work only 6 hours a day or 4 hours a day, and space saying you might want to work only 6 hours a day or 4 hours a day, and for the rest, or half, basically 20 hours a week, and for the other 20 hours, you're doing your own things. And we had those type of arrangements allowing people to do what they really, as she said, wanted to do, but also maybe building a side business. So I think there's means and ways, but there's 22% polyjobbers. That number, by the way, has increased from the study we did in 2016. So that number, and polyjobbers means you have a mainstream job and a side hustle. So we will be burying our heads in the sand. And I think the younger generation also wants, she said they retire in 3 months, I'm done with this job. For you to retain them, you need to give them the space to be able to also do the things that interest them, the things that make, there's a bit of a retention process, a staff retention problem with very young people. You need to find a way to engage them in a way that will make them feel comfortable.
There was a question on how do we bring the informal sector. Anthony, please.
Yeah, thanks. Let me take that. And thanks, Mainga, for that question. Me and you have been stuck in the same industry for the last 25 years. I think there are two aspects for it, Mainga. One is regulations. They've done their part. I wish they were here for us to clap for them. They've provided for creation of products which allow the informal sector to save for retirement. And all those are known to most of us here. And in Old Mutual, we are fortunate. We have two of those. We have an umbrella pension fund and we have an individual pension plan. So the regulatory part has done very well to bring the informal sector to saving for retirement or retirement planning. But the other part is to what extent has the informal sector been engaged to accepting the reality that they need to plan for retirement. And the informal sector is characterized by enterprises where they are owner-managed and they are mid-sized businesses. And to a larger extent, the measure of success for those enterprises, if you speak to an entrepreneur, is the ability to restock what they have sold. As simple as that. So as long as they can restock their shop, their business, or they are getting new clients for the service they are providing, it's a going concern. Some of them even don't pay themselves. And there's a need for us to, as people from the financial services sector, to tell them there's something beyond this enterprise. And this enterprise, if you look at the statistics in Kenya, 7 out of 10 of these enterprises don't live to the third year. And if you speak to venture capitalists, some of them in this room, they'll tell you that in 10 years, a venture capitalist has been in 3 or 4 businesses, showing you the likelihood of failure is very high. That means saving for retirement is important. If you look at their top 3 priorities for entrepreneurs, the informal sector, one is access to credit, not cost of credit, access to credit. Secondly is access to the merchandise which they use to do their service or skill. I know most of you here are not in business because you can't take the demands of the new workforce, which want to retire after 30 days. And then thirdly, and most importantly, for entrepreneurs in the formal sector, a big part of them is how to protect their business and their assets. They view that as a cost. It's a tough discussion for this sector to discuss about protection costs, especially from an insurance perspective. They feel it as a tax. They don't feel it's protecting their businesses and themselves, their own lives. So Mainga, the challenge still remains in the financial services sector to continuously push this informal sector, both employees, founders, business owners, that, especially for the business owners. Today, if you speak to a mid-sized business owner, one of the biggest challenges to attract a highly skilled, experienced professional from the highly informal sector and large corporates is three things. One, provision of a pension plan. Secondly, the provision of a medical cover. And thirdly, the provision of affordable credit. Now, the informal sector needs to be helped to formalize those three needs so that they can attract talent. The only thing they are doing to attract talent is to offer them equity in those businesses. Otherwise, none of these people in this panel will want to work for a medium-sized startup company and give away access to cheap credit, a medical cover, and a pension plan. I hope that helps.
Thank you, Anthony. I have room for one burning question if it exists. There's a hand here. Let's take it. A microphone, please. Please introduce yourself.
Thank you very much. Good morning, everyone. My name is Samuel from NCBA Bank Assurance. It's not a burning question, really, but I just wanted to pick it up from where Anthony has left, because listening to the panel, I was just pondering about some of the insights that have come through from this conversation. So one of the things you notice is that that has come through from Nanzala and even Anthony is that people are borrowing too much, right? We are borrowing practically for everything. And I'm wondering what is driving that behavior, because we are not borrowing to save per se. We are borrowing to go and pay a medical bill. We are borrowing to take a child to school, but it's on emergency basis, right? So even in an integrated financial service group like yourselves, someone will not be borrowing from Faulu to come and buy a medical cover. They'll be borrowing from there to go and pay Aga Khan, right? So I'm just wondering, when did we miss the bus as insurers and in the investment industry? Because in an economy that is heavily reliant on credit to really make ends meet. Meanwhile, on the flip side, even the medical insurance you want people to buy in itself is becoming pricier by the day, right? I mean, not to mention all these other financial pressures that are coming with tax, the crunch on finances and all that. So I guess the question I'm asking Anthony particularly, and maybe Nanzala, is what is driving the behavior to heavily rely on credit? Because it does seem the money is there. Is access to credit then what is cannibalizing the growth of the insurance services and the investment as a whole? And what can we do to solution that gap? Thank you.
It looks like it should be a tag team there.
So, in another study that we did a few years ago, you'll find that 70% of, and it was in a number of countries, but including Kenya, 70% of our income is, of the income, monthly income is not consistent. 70% of the people do not have consistent monthly income. But not only that, there is no consistent monthly expenditure. So you might have a salary, but the shocks of a Harambe for an emergency medical, that's exactly what you described. The shocks of the system where you do not have any support structure creates the cycle where you're not able to actually manage your expenses within that month with the money that you have. So you borrow, you pay, you borrow again. Like that's actually the driving force. But as I said earlier, and I've said this many times, the day we crack how to deal with the financial dynamic, the day we crack that, because the money is there, because you borrow, most of the time it's paid, you pay back. If there's an emergency, the funds are raised. If there's a funeral, in 7 days, everything is in place, the finances for it. So it means that we are a little bit in a cycle. We need to find a way to break that cycle. And if you look at, and again now I'm talking purely from a research perspective, he'll talk from the industry perspective. But from a research perspective, if you look at what is happening, the evolution of chamas, before they were just a merry-go-round. This month I get, next month you get. Actually, it was women. The men decided, no, these guys are doing too well, let's join. So now it's investment clubs. But if you look closely, you'll find that there is welfare and there is the investment side of it. So these are vehicles that are working. Eh? And if you look at the welfare side, it's exactly that. If your parent passes away, we will give you X amount. If you have, if someone in your family, there's systems that are coming in place because, and they're there. So if we can find as a financial services sector a way of moving with the rhythm of the customers we are talking about, where their income is not consistent. Remember, the 70% self-employed, employed in informal business, in the gig industry, and so on. This number is growing. And even those who have got a salary at the end of the month, because of the shocks, they cannot be sure about the end of the month. And even the business owners we were talking about earlier, because of the way the business runs, they cannot commit to a certain premium going every month. What solution can we have that takes into account this very fluid situation and find a way to slowly start managing these shocks? So that we can now move into paying for the medical cover as opposed to paying that medical bill. Borrowing, so I don't know if that answers your question, but I think it's to accept that reality, and it's not getting better, it's actually becoming more prevalent, the inconsistent income month on month.
Anthony, you're chipping in?
Thanks. Maybe in a minute. Thanks, Sam, for that question. By the way, borrowing is not a bad thing. It's actually incurring debt shows ability to service debt. If anyone lends you money, it shows that you can pay it back. We assume that. So borrowing is not a bad thing. And the increase in borrowing, Sam, in Kenya has been driven by two major factors. One, in the financial services sector, lending or access to credit is the most developed part of the financial services sector. So there's been a lot of work which has been done to access credit. My parents retired without borrowing from a bank. One of the jobs I used to do when I was a young person is to queue for my mom to collect her salary, because the queue used to be like 2 hours to go to the counter. What it tells you is that today, access to credit has driven borrowing. In Asia, in Europe, and in the Americas, access to credit has a relationship with the high indebtedness of the citizens of those countries, of those continents. So in Kenya, the same. We are slightly over-leveraged or high in debt or borrowing a lot, not because necessarily we are poorer, but because the access has really improved. I'll give an example again. I have a 20-year-old son who told me he got a loan. And he's in college. It just tells you access to credit has led to where we are. So that's one part, Sam. The second part is access to credit or borrowing has also been used to grow other sections of the financial services businesses. For example, insurance. Just look at the phenomenal growth of insurance premium financing. People who subscribed to an insurance product or an insurance cover over 25 years ago, they had to pay for it from somewhere else other than borrowing. Today, there is no reason why you shouldn't access an insurance product because you can't pay the full annual premium. There's insurance premium financing. And that has again led to a close intermediation and relationship between borrowing or getting higher in debt levels while supporting other. In fact, the insurance industry is a huge beneficiary of our heightened access to credit, and it's a good thing. Lastly, if you look at the levels of Kenya's indebtedness as measured by employers or human capital professionals, and we have some good ones in the room, including Kirote, they will tell you that the numbers being used to measure employees' indebtedness are still low compared to global levels. That means, please don't borrow too much, but the working population still has a higher leg room, if I may call it that way, to borrow. Thanks.
Thank you, Anthony. Mic check. Thank you, Anthony, for that remark. And I'd like us to get to the takeaways from Oginga here. But before that, if you want to know how powerful cultural inhibitions are in financial inclusion penetration, one of the challenges I had 2 years ago, God rest her soul, my mother-in-law passed on. And my dad told me, you know, as a son-in-law, you're supposed to behave in a certain way, so I need this amount of money before you come home. And in a few hours, I'd sent the money, and he goes like, Chief, that was fast. And I tell him, yeah, I took a last expense cover. He was like, what? Do you have one for me as well? He's still alive, so, but he was hoping I didn't have one for him as well. But that's the difference it makes, yeah? But also culture now becomes a very big factor. Bwana CEO, what are your takeouts from this?
Thank you very much, Julian. I think, first of all, just to say a big thank you to the presenters up front. I think it was quite illuminating today. But as I said, I think this is starting to tease out questions, which over the next couple of that optimism also needs to be backed by something. And I would encourage our customers to spend more time with their advisors, especially during these challenging times. You need to think about, this is the time to talk to your advisor about your protection policies. Are you adequately protected? During a difficult time, you don't want a loss event to happen and find who was not adequately covered, or I was over-covered. There also, during these tough times, you need to reassess your goals. Talk to your advisors around the market conditions and how that is impacting your financial goals. What do you need to do differently? Anthony said saving is different from investment. So how much more do you need to invest to keep track of your goals? Right? But conversely, during these tough times, people also go through difficult challenges. So it's also time to talk to your advisors and see how you can work together to get through those difficult times. They can advise you around products, they can advise you around what to do around your, the status of your policies, etc. from a banking perspective, if you are running into trouble, this is the time you stay very close to your bank, not the time to run away. We will find solutions. So, Julians, we've started a conversation. That conversation is enriched by a lot of data, which we'll make available online. But it is going to drive us towards speaking more to Kenyans around what this is saying about our households. And hopefully when we get to the next survey, we will see some shift, a gradual shift forward. But thank you very much.
Thank you, sir. And let's appreciate the panel for the wonderful job. As I usher them back to their seats, please, the exit is via this side. Thank you so much for that very illuminating conversation, and thank you for the questions as well. We are right at the tail end of our engagement this morning. Please, this way. Asanteni sana. Thank you. So, ladies and gentlemen, we have come to the close, and to give us the closing remarks, I'd like to invite Isaac, the Group COO, to give us the closing thoughts, after which we shall continue with our networking session.
Thanks, Julians, and good morning, everyone. I think we've had a lot, so mine is to bring this session to a close. We've got a lot of info that has come through from the Old Mutual Financial Services Monitor. Insights, some of which might be startling, but if it's any consolation, we've been told that they are not necessarily unique. These are shared challenges globally. And with the current economic constraints and declining global growth, obviously households and consumers are stretched everywhere. And as we've been told, usually, and more so in hard times, people tend to discount the future. So focus is on the here and now, things like retirement planning, investment, think about that takes a backseat for the real needs of food and transport and such. But we don't want to settle for simple solutions to these hard truths. And so the response, a collective response to these kind of insights that are telling us behavior of consumers at a point in time is what solutions can we develop to address some of these shared challenges. That's really is the main reason why we do this work. And we've got an objective to build strong and financially stable societies, which then the response, some of which has been mentioned here by our panelists, come to bear. And the Old Mutual Financial Services Monitor, its aim is to bring out these insights and then start to give us indications of what we can do to assure ourselves of financially stable societies that are resilient to global, regional, local challenges and shocks that come from time to time. At Old Mutual, our focus this year is on holistic wellness, including financial wellness. This will come out much stronger in the advice that we give and the solutions that we provide across the organization. So we are very pleased that you could join us this morning to engage on this discussion, that we invite you to continue on this dialogue. As the hashtag Julian said in the morning, if you know better, you can do better. And that's what we are aiming to do. So thank you very much for your attention this morning, and I look forward to continue engagements on this. Thank you.
Asante sana, Isaac, and he has formally brought us to a close of our discussion this morning. Know better, do better. We can keep the conversation going. Mic check, mic check. Sorry to call you back. Jeff Odundo, Arthur, Vuyo, please make your way to the stage here for a photo shoot. A photo shoot, please. A photo shoot. Anthony, are you still in the house? Wangare? Nanzala? Let's do a quick photo shoot, then we... Mic check. Arthur, please. Vuyo and Jeff.